Hey there, everybody. Welcome into this video. I hope y'all are all having a fantastic day. Now, don't mind the thunder if you hear it. There's kind of a massive storm going on right now. I just saw some lightning. All right. But currently, I'm in the market looking for some good deals on, some good deals on multifamily properties, which sadly I'm struggling to find. I was a realtor for a short time, and I do currently have my license, but I left that market as soon as, in my area, it got difficult to find motivated buyers. Or really motivated sellers as well. But I moved on, at least for now. But I do find the current real estate market exceedingly interesting. And today, in this video, I'm going to run through what I'm seeing in that market in general. Let's get into it. So, broad overview. In an effort to wage a war with inflation, the Federal Reserve has been brutally raising the federal funds rate, which is making it exceedingly difficult for the average, if not most, buyers to purchase a new home. The funds rate has gone from around 0 to roughly 4.3% since March of 2022, causing the average 30-year mortgage rate to roughly double to over 6%, meaning the monthly payment for a $300,000 loan has gone from around $1,400 a month to $1,800. Even though home prices did continue to rise immediately following the rate increases, over the past few months they have been on the decline, as you can see in this estimate describing the Affordability Index. What I find the most distressing is when I look further back to pre-pandemic levels. Since the median household family income has increased only 11%, while the median home price has grown by 37%. It's likely lower now since the data was until November of last year, but we still won't know that until early February whenever the National Association of Realtors report comes out. From 2019, the estimated median monthly P&I payment has grown 86%. All that alone sounds poor, but this index shows when qualifying income to purchase a home goes above the median family income, basically when it becomes out of reach for most Americans to buy a new home. We have been riding that line, but as of the end of the year, it was not looking too good for the American dream. With inflation, one would reasonably expect prices of real estate over time, keyword is over time, to rise roughly in line with the amount of dollars printed, the amount of more money flooded into the economy. Total currency in circulation increased by 28%, but M2 money supply increased by over 42%. And as I mentioned earlier, home prices are up around 37% at the moment. So if that is a reasonable assumption, the issue with affordability seems to be arising directly from incomes, just not having the chance to rise fast enough. Now, the real estate market was overly hot, with a lot of hype, not only from people, but also investment funds. But even though the Fed's goal to smother the real estate growth with higher rates will work to lower shelter inflation as people can't afford homes, the problem still remains that all that money just exists now. But I don't want to dive into that too much. Moving on, let's look at some different data. So, new residential home sales increased by 2.3% from November to 616,000 in December. If you look at how this has changed over the full year 2022, sales have fallen sharply, around 25% since the beginning of the year, yet slowly started to rise up again in the last few months of the year, up around 12% from the lows currently. It does seem existing single-family home sales have been hit much harder than new home sales. As you can see from this chart, the majority of the percentage changes since a year ago are greater than 25%, especially in the middle-class purchase range and over in the West. New listings of homes are down 20% year over year. There's a 4-month supply of available homes currently listed and about a 9-month supply of new homes listed, which shows me both potential home buyers and sellers are pulling back and thinking more carefully before making their decisions. There are far fewer pending home sales than any time over the past 3 years, yet there is still about 21.4% of homes still selling above their final list price. Historically, I believe around 17 to 18% of homes sell above asking price, so we are falling much closer to the average. This shows me folks are being more picky about the homes they are buying and making more level-headed choices when evaluating their options. Homes are also staying on the market, an average of 19 days longer than they were just a year ago, and roughly 1 in 7 homes listed have had a price cut in the last 3 months, showing me that we have come a long way from the seller's market we had not too long ago. Then this is a chart showing the estimated mortgage costs for a $500,000 home as it changed since 2015. Now, of course, this is expensive for most home buyers, but wow, those bills have gotten much higher. The U.S. home builder sentiment has fallen every month of 2022, falling even deeper in the month of December. New home starts for beginning construction are slowing, which is not a great sign for builders, but let us look a bit closer. One of the largest builders, KB Homes, had 68% of contracts to buy their homes cancel in Q4 of 2022. Basically meaning, as people looked at the mortgage rates increasing, 68% of people realized they could no longer afford the homes that they had planned on buying. Year over year, their backlog of contracted work has declined 25%, and net order value has fallen by nearly 80%, from $1.7 billion to a minuscule $363 million due to so many buyers pulling back. That is a dramatic change. D.R. Horton saw net orders decline by 38%, a cancellation rate of 27% compared to 15% in the prior year, and the company's backlog of contracts fell by 46%. Now, Lennar Homes said in their earnings call that they were also seeing sequential increases in their cancellation rate, but that it seemed to have peaked in October as it was slowing in November and December, which is interesting. Take that information and do with it what you will. Toll Brothers works in the higher end, mostly building luxury homes, but even at the higher price levels, Toll Brothers had contracts decline by 56% year over year, and their backlog was down 21%. So not as bad, but still very poor. I also wanted to mention what these home builders have been doing with land, because it sheds a light on their behavior knowing all the information about buyers that I just spoke about. KB Homes owns 22% fewer lots than they did in Q4 of 2021 and have lowered their spend on land acquisitions by 74%. D.R. Horton decreased their land holdings by 4%. Toll Brothers decreased their land holdings by 7.5% and noted that they expect to significantly reduce their spend on land acquisition in 2023 in light of our current market condition. One thing I would think about is how many people are employed when a new home is built. Think of wood mills to foundation pourers, construction workers, and appliance manufacturers. It is a long list of people who could potentially be losing their jobs down the chain as new home sales decline. Now, let's take a look at some mortgage default data. I thought it would be much worse, but it doesn't seem to be that brutal yet. In December, borrowers 30 days late on payments increased by 4.8%, yet serious delinquencies of 90 days plus actually saw an improvement, being much lower than a year ago. You can see a little pain when you check out foreclosure numbers. Foreclosure starts had a month-over-month increase of 15% to 26,900 homes. In my last video, I discussed how banks are buffing up their reserves for potential credit losses to come. Even though personal loans are much more likely to be defaulted on before a home loan, JP Morgan, Bank of America, and Wells Fargo all saw mortgage originations decline by 32% or more from Q3 to Q4 of 2022. And they're likely reasoning that mortgage defaults will increase quite a bit in the coming quarters. Moving on, what's going on with renters since about 35% of the population rents their home? So the median rent in the US peaked out at about $2,050 per month in August of 2022 and fell around 3% by the end of the year. Yet in December, rents were still around 25% more than pre-pandemic levels. Quick side note, if you are looking to purchase an investment rental property, I would try finding all this data that I'm talking about specifically for your area, since this broad data does not give a clear enough picture for individual locations. Like here in my city, Houston, rents are down 4%, while in Salt Lake City, rents are up 30% year over year. Massive differences. Back to the video though, using the median family income I showed before of around $90,000, after taking out the typical things a salary job would from your paycheck, you would likely have around $5,000 a month to play around with. And with the common rule of not spending more than 30% of your income, this leaves you with about roughly $1,500 per month to spend on rent. If you take out electricity, water, Wi-Fi, then there's even less you can actually spend on rent. What I'm getting at here is the median rent is above the median pay. So there's likely many properties with high rents, and those rents will have to come down if those landlords want to get renters. If you look here at this semi-depressing image, someone went and did this math for different cities around the US, and this is what they found. Los Angeles hasn't been affordable to the median family since before the 1980s. Miami hasn't been affordable since 2001. And Lord, even look at my city, Houston, has become unaffordable since 2014. And if you have a sharp eye, you would have noticed a sad fact. This chart ends in 2015, so there are likely many more cities that have become unaffordable. If you're questioning that, median rents have increased by 113% since 2015, while median family incomes have only increased by around 20% from the data that I've seen. That is a massive discrepancy and looks like things are only getting worse. With this being said, the room once had in the investment markets to continually raise rents to force properties to have an attractive cap rate seems to be over, and big investment funds are seeing their opportunities disappearing. Cap rates have fallen far below the average, and vacancy rates of residential properties seem to be changing direction and starting to increase. Investor purchases of single-family homes is down 32% year over year, with their purchases of all residential real estate having a sharp decline. Here you can see the massive shift that has occurred since the boom in 2020 and 2021. Investors are purchasing around 17% of total homes being sold, down from around 20% a year ago. Here are a few cities that have been propped up the most from investor money now seeing dramatically lower investor buying, like Phoenix, Portland, and Las Vegas. Redfin has shut down its home flipping business. Zillow has sold all the homes it purchased and has now left the flipping business. As of November 2022, Open Doors home purchases were down 45% year over year. KKR American Homes for Rent and Amherst Holdings all slowed acquisitions of new residential investments, along with Blackstone slowing its investments into single family. I do not think these are moves towards fully leaving this industry as a whole. Many firms will still take the risk for the potential reward, but I do believe they are waiting because they truly believe prices will fall. And if you are like me, you should be very interested in more updates on this information as it becomes available. Lastly, I wanted to throw in a little bit of info about office space tenants and vacancy rates, because it depicts a massive shift in our society away from the once everyone goes to a cubicle in an office for their 9-to-5 job. Since the pandemic, many more companies have been allowing employees to work from home, and this evolution does have an adverse effect on the market, and potentially what cities will look like in the future as less office space is needed. Vacancy rates have been on the rise since 2020, and they do not appear to be slowing. Massive companies are letting their leases expire as more people prefer to work from home. The vacancy rates in many of the U.S.'s largest cities, like New York and San Francisco, have been skyrocketing, and the national average has increased from around 11% in 2019 to over 16% today, which isn't the best sign for the millions of square feet of office space currently under construction in major U.S. cities, or all the office space planned to be under construction in the near future. The adverse effects come in when these office landlords can no longer afford their debt payments due to higher interest rates and lower rents. Many will likely get pinched by this, and we might very well see many office buildings for sale as landlords try to jump out and as more fall into foreclosure, getting repossessed by banks and listed back onto the market. To sum up my thoughts, the real estate market is showing signs of weakness as a whole, but especially it's showing signs of weakness in those specific areas that got to the most bubblish territory. Now, buyers do seem to be being more considerate and are making more educated decisions, making sure they're more prepared before buying, which is a very good sign. Those who did already buy need to do as much as they can to prepare their bank accounts for potentially harder times ahead in the future. Be thinking of what they would do if them or their significant others lost their job, or they could potentially end up losing their homes. Personally, I do believe the Federal Reserve is quite likely to keep the funds rate high for longer than necessary, and I believe if they do let off the gas, they will probably need to wind up tightening once again, which I truly hope is not necessary, because it would just prolong this potential recession that we're going to have. This belief may be wrong, although if it is not, it is likely that there will be much more layoffs and much more pain being felt across our country in the near future. Now, I'm still no expert after doing all this research, yet personally, I believe the median existing home prices will fall between 7.5% to 12.5% at least, and the average new residential home prices will fall between 10 to 15% at least. As recent home buyers are pushed from their homes due to the loss of jobs, home builders try to remove inventory from their balance sheets to show growth to investors, and institutions continue to sell out of single-family residential properties. That being said, when looking at the massive increases in money supply that have been flooded into our economy, I do believe homes in 2025 will likely be at these prices or even much higher as inflation makes its way through the economy to increase wages. Now, I hope all y'all enjoyed this video. I hope you got some incredible information out of it, but I want to start doing this thing at the end of my videos where I leave y'all with a quote that I think is significant, and here's the one for today. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. Now, we're in a recession, but that was a quote by Peter Lynch, and I find it quite insightful. Now, I hope all of y'all have a fantastic rest of your day, and never stop trying to be better. I'll see you on the next one.